how to identify high growth suburbs using data. The primary thing to identifying high growth suburbs is essentially not to look at data at all, which is a paradox and is counterintuitive. What I'm trying to say is that every research process must primarily begin with the individual and their circumstance, okay? And at HtAG Analytics, for example, we define the individual circumstance by answering the 5 core questions. What is your budget? What is your investment time horizon? When do you plan to extract equity into the subsequent purchase, which also talks about your levels of serviceability and how much you can borrow? What is your risk profile? And number 5 is, what is your primary investment domain? Is it cash flow or capital growth? Now, why is it important to first define the brief? And I'll talk about some examples regarding answers to these questions and how this informs the research process. Now, coming back to why this is important. Well, when you're using data or metrics to find the best suburb, the meaning and significance of data points that you choose shifts on the basis of what you are trying to achieve. And let me give you an example. So let's say you're an investor who is looking to buy in an area for cash flow purposes. You are at the back end of your portfolio building process, you're looking for cash flow properties, and that inadvertently, that situation would imply a selection of metrics that you must focus on and a selection of metrics that you must sort of disregard. So for example, in that instance, you'll be focusing on metrics such as yield, rental projection, vacancy rates, etc. So coming back to how to identify growth suburbs, I always say a hotspot for me is not a hotspot for you because we might have 2 completely different budget ranges. If I have only $550K to spend to invest in property and you have $850, we will not be looking in the same area at all. Which is why, as I mentioned before, it is essential for you to primarily define your brief or your current circumstance. And as I've mentioned before, you will be answering those 5 questions that I've mentioned. What is your budget? What is your investment time horizon? When do you plan to extract equity into the subsequent purchase? What is your risk profile? And what stage are you at in your portfolio building process? Are you just accumulating assets now, which means that you need to focus on capital growth? Or are you at a stage where you're consolidating, selling assets down, and you're looking for cash flow? Now, answers to these 5 questions informs which metrics are important, okay? So for example, there are certain essential or macro metrics that need to be present across every brief, meaning across every potential or possible variation when it comes to the answers to those 5 questions, okay? So primarily, one of the most metrics or data points that you can look at is essentially data accuracy. If you're making a decision on the basis of data, it implies that the information that you're looking at actually needs to be very accurate. And how do we derive data accuracy? Well, we derive data accuracy from volume of sales. The more volume of sales there is in a particular area, the more of a discernible pattern you can extrapolate from that data set. Now, let me simplify what I'm trying to say. For example, if you have one sale today in an area and then another sale in 3 months, one sale was finalized for 25 days on market. Let's say after 25 days, the property was sold. The other sale 3 months later was sold after 120 days. Now, if we draw an average of that to determine days on market, we would actually make a mistake because you cannot determine an average from 2 data points only. You need much larger volumes to actually determine an average of something. So therefore, primarily, if you're making a decision on the basis of data, it is very important that the data that you're looking at is accurate, which is why you need to choose providers that segregate or separate data points in terms of their accuracy. Now, let me give you an example. We have 15,000 suburbs in Australia. Out of those 15,000 suburbs, only 6,000 suburbs have sufficient volume of sales from which we can make a decision, yeah? Now, those 6,000 are further separated or segregated into high data confidence, medium data confidence, and low data confidence. Low data confidence will be the example that I've given. 2 sales within 1 quarter, within 3 months. So data confidence, to reiterate, is one of the most important metrics that you need to consider, and it usually needs to be present across every brief. The second metric that in most instances needs to be present across every brief is risk. Now, a lot of individuals do not quantify risk at all when it comes to investing. And this also specifically relates to the answer to question number 2. And what was the question number 2 in the brief creation process that we've discussed? It is essentially, how long do you plan to hold the asset in your portfolio? So if you plan to hold the asset in your portfolio long term, that means that you need to minimize the volatility in the price movement of that suburb. To give an example, imagine an area grows 20% in value within the next 2 years, and then that 20% gets evaporated and it actually hits the 0 mark thereafter, 2 years after that. It means that you've only made 20% on paper, and those gains actually got evaporated 2 years later, which means that your annual average is essentially 0. So to minimize the volatility of an area, to ensure that we invest in an area that has long-term duration, that has the capability to return higher annual averages, we need to address risk. Different platforms and different individuals address risk in a different way. At HtAG, we separate risk into 2 different domains. So you have the economic domain and the environmental domain. And just before I start talking about these 2 domains, I would like to just emphasize how we at HtAG consider risk. Risk is essentially an impediment to the outcome that we are trying to achieve, okay? And there are primarily 2 outcomes in property investing. We either want capital growth or we want cash flow, okay? So risk is anything that will stop us from achieving that outcome. Now, coming back to types of risk, which is economic risk, environmental risk. Economic risk is usually related to the notion called industry diversification. So essentially suburbs that have very highly centralized industries, they also experience very high levels of volatility with respect to price movements. For example, you'll see a lot of suburbs or a lot of towns that have a centralized industry, such as a single mining town, for example. Those suburbs tend to exhibit a lot of growth within the short term, but that growth thereafter gets completely evaporated. Not only that, you have a lot of suburbs that have very centralized industries that see substantial negative growth across 1 decade, for example. So it is very important that if we want substantial but also sustainable growth, if we want to reduce volatility in price movements of a suburb, and inadvertently by reducing it, we are increasing our annual compounded averages that we use to further leverage into additional assets when we refinance or extract the equity, we must be investing in diversified towns. And let me just give you a simple example. Imagine you're investing in a mining town, okay? Now, and your asset hold time frame is 10 years. Remember, we always must come back to the brief and the answers we provide to those 5 questions. Let's assume that the answer that we provided is we want to hold the asset in our portfolio long term. And let's say we somehow invested in a mining town and we're going to hold the asset in our portfolio long-term, i.e. 10 years plus. During that time frame, we will see at least one macroeconomic shift that will impact that industry in question. Okay, so we might see China imposing tariffs on the exports of our coal, which means that the organization that's operating within that town will have increased cost of operations. And when companies experience increased cost of operations, they usually cut it in multiple ways. But one of the ways is to actually relinquish the workforce, to reduce the number of people working for the organization in order to cut costs. And that negatively manifests on the purchasing patterns. Think about it this way. If everyone in a suburb is employed for a single organization, when that organization starts cutting cost, people will have diminishing purchasing power. Yeah, and that will negatively manifest on future price growth, and it will increase the levels of volatility that suburb experience when it comes to price movements. So coming back to what I mentioned before, if you're holding an asset long term, you're bound to go through at least one macroeconomic shift. Whether that example is tariffs or whether that example is, increasing interest rates would also increase production costs for that mining town, for example. So this is why it's important to address that economic domain or industry centralization domain. Another aspect that we need to consider is negative environmental impact on our holding cost. So to give you an example, if you're investing in suburbs that have high exposure to flooding and bushfires, your holding costs will increase. How? Well, you're going to need to outlay additional funds for substantial repairs if you've been affected by flooding and bushfires, which will increase your holding cost and make it more difficult for you to maintain the asset. Therefore, suburbs that have high exposure to flooding and bushfires, they're usually not appealing to investors. And this creates a problem for growth. Let me explain how. In order for us to see above average price growth, we need to have two cohorts competing for the same asset. What are those cohorts? You have the owner-occupier cohort and the investor cohort. They both need to be competing for the same asset in order for us to see above average price growth. And if you're investing in towns that are not appealing to investors, you are diminishing the participation of one cohort, which is the investor cohort. And therefore, you will not be generating optimal returns from that suburb. So coming back to investment time horizon, one of the important metrics is risk that you need to consider, especially if your investment time horizon is long-term. And two domains that you need to address is the economic or industry centralization domain. And the second one is negative environmental effects, such as exposure to flooding and bushfires. So let me just recap. The first essential metric is data accuracy. The second essential metric is risk, okay? Now, what is the third essential metric that in most instances for most briefs we need to address? And it is affordability. Now, there is an affordability crisis when it comes to purchasing property in Australia. And it is the result of an increased disparity between wage growth and property price growth, okay? So the disparity between wage growth and property price growth has been the biggest since 1970, okay? So we got to have a very large and sufficient sample size to realize that this is the problem. This is why at HtAG, for example, most of the briefs that I receive to analyze for clients are for price points that are 550K and below for investors. Investors usually do not have sufficient finances to enter markets at the 900K or $1 million price point. So affordability is extremely important, not only because of investors and their capacity to actually participate in markets, but actually primarily because of owner-occupiers. We need to be investing in areas where property is very affordable for its internal residents. I usually use the term internal residents. What I actually mean by that is where the property is affordable for the owner-occupier base. When the property is affordable for the owner-occupier base, you will see larger levels of participation from owner-occupiers and more volume of purchasing, which leads to price growth. And again, this is one of these important metrics also that invites two cohorts to participate in the same market, which leads to above average price growth. So think about it this way. If you have a suburb that's extremely affordable for owner-occupiers, they start purchasing. When they start purchasing, you see small increases in price. Small increases in price actually lead to further additional increases as people want to buy an asset until it becomes too expensive. That leads to reasonable growth and actually invites investors to migrate to the market to leverage that growth. And at that point, you see substantial competition between both owner-occupiers and investors, which again leads to above average price growth. So affordability is essential, and I would say it's one of these metrics that must be addressed in every circumstance, at every price point, brief, etc. Think about it this way. I mean, if we, as you know, our purchasing patterns are definitely altered by how affordable something is. I usually use an example. When I moved to Australia in 2000, I could fill a shopping trolley with $20. Now it takes me $300 to fill a shopping trolley. What does that mean? I might go to Aldi, or I might go to a farmer's market. See how my purchasing patterns are altered on the basis of how affordable something is. And this is specifically prevalent or pertinent or important when we are making an outlay that is $500,000. So data point number 4, for example, that can be used to, or must be used essentially for every brief. Not every brief, I'll put a caveat against that, but most briefs, and which provides an essential foundation for both short-term and long-term price growth, is socioeconomics. Now, think about all of these metrics that I've mentioned already, which is data confidence, risk, affordability. We are now going through a process of forming a narrative. A logical narrative that will increase the probability of us achieving results, whether it's cash flow or growth, yeah? So this narrative is essentially a combination of metrics with their inherent relationships. And let me just explain what I mean by that. We've addressed data confidence, so we eliminated uncertainty from low and medium confidence data sets, and this uncertainty is actually reflected in areas that have low and medium confidence data sets. They change sporadically from month to month, and they're very unpredictable when it comes to movement. We've also addressed the risk score, which means that we eliminated the volatility that a suburb can experience due to industry centralization. Thirdly, we've addressed the affordability of property within a particular suburb, making it affordable for the owner-occupier cohort and the investor cohort to participate in the market and compete for the same asset. Now, number 4, if we address socioeconomics, we are setting that perfect foundation for long-term and short-term growth. Imagine if you invest in an area that has great socioeconomics on the one hand, and on the other hand, has very high levels of affordability. So what you're saying essentially to the data set where you're doing research, you're saying, give me an area where people have high purchasing power and also an area where property is inexpensive for that cohort. That you're creating a perfect storm. And essentially, by addressing these 4 metrics, you're nearly 50% there to making the right choice. Now, why I mentioned when I started speaking about socioeconomics, I mentioned that it doesn't need to be present across every brief. And it specifically relates back to the price point. So usually for price points that are 550K or below, so if you're investing in markets that are 350, 450, socioeconomics does not play a dominant role when it comes to long-term price growth. Why? Well, common sense would dictate that when you're investing in an area that's 450K in value, you are bound to invest in markets of lower socioeconomic standing, which is why that area is sitting at that 450K mark. Okay, and there are many areas that are sitting below 550,000 in value that have seen substantial growth in the last decade. So what I'm trying to say is that poor socioeconomics does not inadvertently mean lack of long-term growth, but that needs to be centralized for values that are below 550. Okay, so contrary to that, socioeconomics plays a dominant role when it comes to both short-term and long-term price growth, for price points that are above 550 or 600K, okay? And there is a simple test that you can do. Let's say on HtAG, you go on and you set the price at 1.4 million and above. You allow for high data confidence, meaning that the information that we are looking at has high levels of accuracy. And you look at the price growth in the last decade, and you observe only those areas that have doubled in the last decade, i.e. they've started with 700K a decade ago and then came to 1.4 million today, okay? Now, I'm not allowing for compounding there. And if you look at all of those suburbs that have actually doubled from the 700K point, you will see that there are no areas in there that have disadvantageous socioeconomics. Now, socioeconomics on HtAG is a metric that's called ERSAD, or referred to as ERSAD. And the definition is relative index of socioeconomic advantage and disadvantage. It is a score from 1 to 10. Areas that are disadvantageous have a score of 1 and 2. Neutral areas, when it comes to socioeconomics, or balanced, if you will, have a score between 3 to 8 inclusive, and then 9 and 10 are opportunistic areas. So coming back to our example, there is 0% chance that an area that is 700K in value will double in a decade with a socioeconomic score of 1 or 2, being socioeconomically disadvantageous. The higher we go up the price point, the more important the socioeconomics of that area becomes. And in unison, with very high levels of affordability, with reduced levels of volatility, which we have addressed by, inspecting the levels of industry centralization in the area, and with high data accuracy, we are building a very robust foundation that essentially is getting us to about 50% of a good decision. All we need to do is additional 50%, and we will definitely pick an area that will grow in value both short-term and long-term.